All right, well, let's look at the US markets. And we're looking, as always, at four markets: S&P, the Dow, NASDAQ, and Russell 2000. And here we are going to start with where we left in 2019. I believe that we were last talking somewhere here at this spot. And we have said that this particular area was a confirmation of the break to the downside. We have committed below the local support, and we also started to commit below the support that was formed back in February, March, April. And that obviously confirmed a downtrend or a down bias. And we said that most likely we're going to have acceleration of the price to the downside on the background of the accelerating volume signature increase, where we're thinking that supply is going to increase, but at the same time, going below the support is going to create some kind of value for institutions, and they're going to start buying, and we see that in the volume signature. So that increase in the volume signature right here suggests that there is some buying. The next bar shows somewhat of the exhaustion, and obviously this is all related to the holidays, to Christmas, but still, if we would just interpret volume and spread signature, that's how we would be thinking about this. And we said that most likely we're going to have some kind of climactic stop in action. We definitely experienced that. All of the elements of the climax are there. Increased volume signature, acceleration to the downside, increased spread, stop in action by itself, and we are definitely in the oversold condition here. We're looking at the downtrend that we have had since the upthrust, and we are definitely in the oversold, and this is where we are expecting climactic action to occur. So what would happen after the climactic action? Well, out of the oversold condition, we usually have some kind of bounce. So the biggest question for today's session is going to be what kind of bounce we're going to have, what kind of quality of the rally we're going to have. And also we're going to talk about a possible discussion of what should come next. Are we going to have another trading range? Are we going to have potential rally, or could we collapse from here and continue to the downside? Bruce, so what's your overall bias theme right now when you look at the markets in general? What is the predominant thought that you have about the bias?
Well, the concern that I would have is that we have had this major fourth quarter event that has taken these indexes down and out of their range bound condition, out of their trading range. And this is a major action by the market. And this has come with the force of the expansion of supply. And so my concern is, does this market have the ability to be able to lift back up into the trading range, or does it not? We identified at the beginning of 2018 a major change of character with a buying climax, automatic reaction, huge outsized reaction compared to the uptrend that we were in before. And at that time, just using, foundational Wyckoff technique, we established that there was going to be a range-bound market for some period of time into the future. And we can see that is the case really across all of these indexes. And so after the upthrust that we had into what we are calling an upthrust after distribution, we had the classic response to that, which was a failure. So after that upthrust after distribution, we had major liquidation by strong hands in a volatile market with high volume, and this took us down and out of the range-bound condition. So this is the major event of the year. And so now, as Ramon said, we are going to determine whether or not, or establish if we can, whether or not this market can conduct itself in a maybe an accumulation of sorts where it can have a more important rally, or whether or not we redistribute for another move down. We could say here that we're under the ice, and that the inability of the market to show good price action with good demand that takes it back above the ice and keeps it there, that this becomes a very vulnerable place for the market. And so we're going to be looking very, very closely at these scenarios.
Well, during the first phases, phase A and phase B of a trading range, we are going to have a lot of volatility. So our expectation is that for the next month or two or few months, and especially going into the trade talk deadline and other events that are on the horizon, we're still dealing with the budgetary things. We're probably going to have a lot of volatility up and down, but predominantly we're just looking for a couple of scenarios. The first scenario is just a trading range, and we kind of established that we have a selling climax. We are in the rally mode right now, short term. So we are still thinking about where automatic rally or automatic response could come to. And usually it would come to the area of the resistance. And we see how we're very, very close to that. On the Dow, which is clearly outperforming, the Dow, if having another good day, could be back into the major trading range. And this would be a really, really good bullish behavior and development. So a trading range, and out of the trading range, a question of the bias. Is it to the upside or to the downside? Or another scenario, would we have some kind of attempt to return back into the major trading range? All right, Bruce.
I'd like to just say that one thing that is encouraging to me, and I believe that with what's happened here in the fourth quarter and into the end of the year, we have been saying over the course of the last number of sessions that the market was headed towards the end of the year, end of the quarter, with a lot of supply, and that it was likely to end the year near its lows. And that's exactly what's happened. And so here, the interesting thing is, look at the S&P. It's gone under its downtrending channel, and so that's an oversold condition. We have point and figure counts in these different indexes, which count to the area that it went to, where it stopped, and we've had a good bounce after that. So we have an oversold condition, we have a climactic decline into the lows at the end of the quarter, end of the year, and we have an oversold condition in the trend channel. And so these are all things that would lead us to believe that, at least on a local, in a localized area, that we have a new range-bound condition and possibly the conditions for a bounce in the new year. And so we think a lot of selling got accelerated into 2018. Now that we're in 2019, we have the potential for a vacuum of selling, which could produce maybe short covering and some other phenomena that could drive prices up a little higher, and maybe even up to that rising trend channel that is drawn on the chart. So we have the reasons to think that the market is done going down for a while, and maybe it's going to reform for another decline, but we're going to wait and watch and see what happens here. And these point and figure counts have been quite good so far.
And I see that you guys have a lot of comments about the futures, that they are down on Apple News. Yes, Apple just announced some, earnings guidance and some, decrease in sales, deceleration of sales, and, with the references to the trade talks. And this is a very typical behavior for the environment that we're in.
I mean, we could say that Apple has been discounting bad news coming with its weakness, because it's the price action will precede the news. Mm-hmm. Anyway, Ramon.
So it's not unusual that at the points of the resistance, we're going to have some kind of, catalyst, and Apple acts as this catalyst to produce a sell-off, because the sentiment is still very much bearish. And actually, Bruce, next week, let's talk about the sentiment, right? So let's Let's look at the breadth,
Yes.
and let's look at the breadth on this rally, and let's just see how the events are going to unfold. But again, guys, we are in this formation right here, so far we could do this. So don't be alarmed that during this type of the consolidation, we could have multiple days where we have a significant move either to the upside or to the downside. That's typically
The,
what happens in the trading range.
the composite operator will, uh, when there's a sharp break like we've had that has some of the elements of climactic action and into a point and figure count area, there will be a bounce, and then after the bounce, the market will tend to go back down and retest the lows of that area, and it's the CO types gauging whether or not there is supply that's of a size that can drive the market down into a new downtrend or not. So they're asking the question here, with the return back to the lows and secondary testing, whether or not the market can hold in this area and then produce a more important bounce. So we always expect testing.
Well,
And
let's look at this test, Bruce.
just the Apple news alone may be the thing that helps to produce that test.
Yeah, that
So go
catalyst
ahead,
that
sorry.
produces that sentiment to push the price down. But let's look at examples of those tests, and let's look at some analogs. So we were discussing in December a lot of analogs that were based on moving averages. Again, really quickly, I'm going to repeat: the red one is 21 days. This is just a month's reference to a month. The blue one is 63 days. That's a quarter. The green one is 252. That's a year. So we are actually not using 200 moving average. And then the black one was 504, which is 2-year moving average. And we're looking at the first analog and the first scenario, bearish scenario. Well, why? Well, because we have lower highs, lower lows, a definition of a downtrend. So that's the bias that we are looking at first. And we said in the last session that we were somewhere here. And look how analog works so nicely. So if you just caught that session, that latest session, and traded on the intraday level, there was a lot of money to be made to the downside into the climactic action. In 2007, we're seeing that after the climactic action, out of the oversold condition where we saw the increase of the volume signature and the supply, and which acted as a major sign of weakness in this case, we had a rebound, and we had a very sharp rebound. So, and that's exactly where we are, and this blue box right here is showing us on the analog where we are. We are somewhere here. So if we are going to have some kind of test that comes next, look again at how quickly we go down. And this happens because the sentiment, the bearish sentiment, is still prevailing for the majority of the participants. And they are willing to sell much faster all of their long positions, and they're willing to short the market much faster at this point of time. So we are going to have, still a lot of volatility. We would be expecting something like this to unfold.
And there's our test.
Yeah, and here is our test right here. And I mean, with Apple News, Bruce, I really was encouraged how today the close happened. So we had some selling into the opening, and then everything was lifted by the close of the session. That's a bullish sign right there. But obviously, Apple could produce that bearish news. Okay, well, let's quickly move to another analog because we have quite a lot to cover here. A bullish scenario. I'm bringing to your attention a couple of bullish scenarios here. One is in 1998. And I want to point your attention to this analog because of how the uptrend, which was a secular uptrend, and that uptrend was violated in 1998. During the Russian default, we had almost the same type of the situation where the sentiment, bearish sentiment, has increased so much on the violation of that uptrend. But after that, after the consolidation in the very volatile trading range, we had a very, very quick rally up. So we have to think about that. In 2016, also in the out of the oversold condition, um, in the long-term uptrend, we are finding a rally after that, and therefore a question here: are we violating secular uptrend at this point of time, or have we just created an oversold condition right here? Bruce, what do you think?
I'm going to tend towards the idea that we've climaxed. I want to see a good test, and then I'm expecting to see the market come back up into that channel. But my market action could change my mind. But this, I think, we're in a good place to get a bounce back up into the channel.
Mm-hmm. Okay, so these are the bullish scenarios that we would be looking at, and then one more scenario that I want to bring to your attention, guys. So this is something that we study in the Wyckoff Trading course and Wyckoff Practicum. So this is not necessarily uh, the pattern that usually on the conventional schematics you will see. This is a diamond formation and what I call a very complex reaccumulation with some distributional elements. So what am I talking about? Well, there is definitely a reaccumulation texture, and by texture I mean how the price behaves and how the volume signature behaves. We see the diminishing volume signature into the second low, which is a higher low. That suggests a reaccumulation and the move up. Only to see that rally stop at the point of the resistance, and that becomes an attempt to upthrust rather than a sign of strength. And then we go into some distribution where there is some selling. We see an increase of the supply signature, and that distribution creates a short-term downtrend that leads to an oversold condition. That oversold condition will always be a lower low in this whole structure, and it will be the lowest point in the whole structure because of the overall bias to the upside. If we would look in the hindsight at the whole structure, we would know that this was a reaccumulation. But that at that point, at the point of the spring, think about the sentiment that people have at that point, and it's definitely extremely bearish. So therefore, for those institutions that still see value, this is a great event to come in and establish the positions. And as they do so, look at the volume signature here. They're very consistent and they are somewhat aggressive, in establishing this position. And that could produce a very meaningful rally. In 2 months in Tesla, we had this rally off the lows out of the most bearish sentiment that we have had. The same pattern has happened in the Dow Industrial in between 1965 and 1980s. And we had the conditions where there were a spring condition in 69 that led to the rally that failed. So this reminds me of this rally right here. And that created a short-term downtrend. And that downtrend brought us to the new lower low, to the oversold condition, to a spring, and look again at this rally, very aggressive rally, sharp rally to the resistance. So this could be one of those scenarios, and we kind of doing the same thing here, Bruce, right? So reaccumulation texture since the highs and since the lows here, absorption, a rally into the upthrust situation, and then local distribution and the short-term downtrend, lower highs, lower lows, oversold condition. So here we're thinking either we're going to have a rally or we're just going to have a trading range. And obviously a rally would be more of a bullish condition, and then a trading range would most likely suggest a continuation of the downtrend unless trading range happens really fast. There is a very aggressive, quick accumulation, and that could push the price up. Bruce, talking about 1974 market, um, I thought that was a great analog, and you brought this up as well. But you're bringing this up in such a very interesting, unique perspective. So tell us, what do you think about this analog?
This is the Dow Jones Industrials 1970, late 69, 70 to 1975. And I was just trying to think of the different analogs that could speak to our current situation. And what really struck me was in the beginning of October, at the beginning of the fourth quarter, the market had a decidedly different change of character, turned into a downtrend, supply was present, and the market just started marking down. And this was into the election first Tuesday in November. So this is a month ahead of time. So I was thinking about the election, and I really want this discussion not to be about politics. I want it to be about tactics and about analogs, because I'm not, especially when it comes to the market, I'm not political. I don't think in a political way. I think in a tactical way. So I'm having a discussion here a little bit about politics, but I'm doing it because I think there's an analog here. So very briefly, you can see the Watergate break-in occurred in June of 72, and I have an arrow to the week where the break-in occurred. Now, the thing is about that break-in was that it was a very obscure story, didn't mean much to anybody, it was like page 7 news. Now you can see that in November, so this is June into November, so you can see how big the structure is. It's a multi-year structure, classic distribution. And into the election, the market goes up to and through 1,000 on the Dow, which was a very big, important, round psychological number for the market. And in this case, the rally followed through into the end of 72, which is, again, so this is, in this case, it rallies up into the end of the year and then has a sea change, just a complete change of character, and starts to liquidate on a pretty steady basis. After a minor sign of weakness, there's a last point of supply, which is a short covering rally of sorts, and then a very important decline that went right to support, major sign of weakness, and then a rally of very poor quality into a last point of supply. Well, now during this whole period, from this upthrust all the way over to the breaking of the ice, is the momentum of the story that the Watergate break-in had Richard Nixon's signature or his fingerprints all over it. And so at least that's the way the press made it out to be. He had a 49 state landslide victory in the election. And so he won by a huge margin. But what happened after that is that the Watergate story got closer and closer and closer to him. And there was a Democratic Congress that was investigating and investigating and investigating this whole thing, and was hostile to Nixon. Now, that sounds kind of familiar to the situation now, the difference being that the House was turned over to the Democrats in November. And so the investigation, then they have said that they're going to investigate President Trump, and they're going to investigate him for these supposed events which involve, for among other things, Russia. And so whether or not there's a smoking gun there or not, they didn't know that there was a smoking gun for Watergate, and they just kept investigating, and the investigations got closer and closer to President Nixon. And so here, I think that these kinds of things which are politically destabilizing, are things that the market doesn't like. And so the market is looking ahead at the next 2 years into the 2020 elections, and is saying that there is going to be a war, a battle of wills between now and 2020, where there's going to be investigation after investigation by the opposing party, and they're going to try to find smoking guns. They're going to try to find things that they can pin on the president to diminish him into the 2020 election and possibly even could lead to impeachment. And they have said this themselves. And so here we can see that impeachment became inevitable in the Watergate scandal. And in the final stages, you can see that Richard Nixon was counseled that impeachment was going to occur and that the Senate, where the trial would be held, would convict him. And so President Nixon elected to resign instead of go through those events, which would be impeachment and then the trial in the Senate. And so you can see that 6 weeks, approximately 6 weeks before the low, he resigned, and then that low that was made after his resignation, which produced a cause, an important cause in that structure, was the end of the bear market. And that bear market, from the upthrust all the way down to the selling climax, was inflation adjusted, one of the worst bear markets we'd had since 1929-32. You can see how much interest rates went up throughout that whole period. We have rising interest rates now. So there are some parallels here. I think it's just the political cross currents that the market doesn't like. I don't think that it's going to be anything like this, but we can see some analogs here that we might want to pay attention to, that we could cue our tactics and strategies off of. So anyway, that's all I'll say about that today.
All right, great. Look at this, guys. So upsloping range, the texture of this area right here suggests a move up thrust, and then kind of reminds me of what we have had, right? So the first leg down, another consolidation area, major break to the downside as a major sign of weakness, and now we are rebounding up. So I would say that, Bruce, that we're probably somewhere here. We could be somewhere here. We're close at the support, major sign of weakness, and then we could definitely move to the downside really, really quickly if, what you're saying, Bruce, is going to materialize and there's going to be some kind of, attack, on the president or, the Republicans in general before the elections.
It's just going to be generally, investigation after investigation. I don't know what's going to happen. I don't know that there's anything there. They didn't know that there was anything behind Watergate at the time, but they just kept investigating. And so there may be nothing, but I see no scenario where the investigations stop until the 2020 election time is over. And so just the effect of having this constant barrage of investigations and of news and in the press, like it was under Watergate, has similarities. There's commonalities there. And so beyond that, I don't understand the politics. I don't know what's going to happen. I'm just thinking about how the market might look at it.